As far as the shipping industry is concerned, as of now it is basically a mixed bag, so to speak. As they say that one man's meat is another man's poison. So there is a global kind of a slowdown which is happening in the economy. But at the same time you would have noticed that because of this slowdown, and there are several other factors including the price and the supply related negotiations which the OPEC, oil producing countries along with Russia, they have had, and the net result of whatever happened is that there has been a glut, so to speak, or an additional supply of oil which is available. On one hand, Saudi Arabia has said that it will increase pumping of oil. So they will increase their production by say around 3 million barrels a day from next month, that is next week, within the next few days. And that is having a downward pressure on the oil prices. At the same time, from the demand side also, you would notice that this coronavirus is slowing down the demand, and the result of this additional supply and less demand means that there is a surplus available, and whenever there is a surplus, prices are expected to fall. But what we have seen now is an unprecedented, unusual, or a very drastic, we can even use the word crash. Crash is a very strong word when it comes to the market. So there is a crash in prices. Now the oil prices would range around, depending on what grade and which futures we are talking about, to $22 a barrel to $28 a barrel. This is a very low price historically speaking, and this indicates that their demand is very low. But for the shipping industry, when we see that the prices are so low, then there is always a window of opportunity, a business that people want to buy. The importers, the refineries, they want to buy now to be used later. That means that they will be buying additional volumes to the extent possible. Their finances, their medium-term outlook of consumption, and their ability to store, these are the factors which determine that how much oil one can buy, even though that refinery or that country or that importer is not immediately using that oil. And this is the reason why we are seeing for the last few weeks there is a huge demand when it comes to buying crude oil, and that demand translates into more requirement of ships, not only for moving oil from place A to B, for example from Middle East to Far East or Middle East to India, but at the same time it also means using your ship itself for storage. When your shore tanks are full, there is a certain storage capability or a capacity which is available in different geographical regions and countries, and that is all full. And then what the trading companies do, they start storing oil in the ship itself. So I am not sure whether everybody, the common man, would be familiar with the term floating storage. But whenever the market is in a contango or when there is less demand to consume, floating storage, that is storing oil on ships, that gains ground. And the very large crude carriers, we also call them VLCCs or super tankers. So one such ship can store or move or load or discharge 2 million barrels of oil. When Saudi Arabia itself is saying that I am going to increase my production by 3 million barrels a day, so that means they are increasing by 1.5 VLCC equivalent of oil per day of pumping. So all this will be stored or moved or purchased by countries in East Asia or which are the buyers, and that has resulted in an increase in freight rates. So this month, if you look at, except for precious metals which went up and then suddenly fell down, the rates, freight has been a very positive and a very strong performing asset class, because there is so much of demand to buy cheaper oil and move it and store it, that to put things in perspective, that if somebody is taking a ship on hire, we call it charter. If you are chartering a ship to move oil, the VLCC, the very large crude carrier, for moving oil from Middle East to Far East to China, owner of that ship can earn as much as $120,000 per day. If somebody wants to hire a ship, charter a ship, we call it short-term time charter, for 3 months to store the oil for 3 months, and when the situation is better, then sell it, then that the rates for that time charter could be as high as $80,000 per day of hire. Because those oil companies or trading companies, they have already done their maths, they have done their calculation, they are looking at the futures prices, they are looking at how much the market is in contango. Contango would be that the price of oil in future is higher than the current price. So if they see that even if the price is $1 or $2 higher, then they do their maths that we are going to store this oil in the ship for 2 months or 3 months. This is the price, that the higher cost, the charter cost we will pay, and that is $80,000 or $100,000 per day, and this is the cost of credit since we have taken money on credit, and this is the X number of days we are going to store it. This is the storage cost, and this is the fuel cost, because ships use fuel. When ships use fuel, it is called bunkers. These bunkers, they also cost, so they look at the bunker cost. So all these calculations they do, and they according to their maths, if the current trend continues, they will still be at a profit buying cheaper oil today to sell it 3 months down the line. So if you have that wherewithal, the financial muscle to buy a certain number of barrels, say half a dozen VLCCs, and then store it in a certain place outside port limits where you don't have to pay port costs. So in this region, Southeast Asia, outside Singapore or in the Malaysia region, you can store that oil. And as and when the requirement comes in from a country like China, which is world's largest importer, then you can ship it to that country. It is not necessary that that entire 2 million barrels of oil which is in the VLCC could be shipped in one go. There is a concept in shipping called STS, ship to ship transfer. So smaller parcels in smaller ships, you can transfer it and send it as per the requirement of the refineries. And the positive point which they are looking at is that China now, the general perception, it may or may not be correct in future, is that the worst phase of coronavirus in China could probably be over. The demand may again start picking up. So this requirement will come from China, because there is also a contrarian view that you are now buying oil at $22 a barrel or $28 a barrel and storing it now, assuming that that $2 additional you will get 3 months down the line. But that may not happen if prices continue to fall. There is one perception, there are certain independent forecasters who even say that the worst is yet to come. So that means oil may even go in single digits. That scenario is yet to come. Then this contango mathematics, as it happens in business, there is always a flip side or a negative side, and then you may even get losses out of it if 6 months down the line the prices of crude are lower. But as far as the shipping industry is concerned, if somebody has taken the ship on charter, it's his or that company, that trading company who is storing oil, it's his prerogative to see to it whether that math works or not. But the ship owner has given his ship. He is getting his $80,000 per day.